While most of the world was celebrating silver's breakout above $75, something very different was happening behind closed doors. This was not trading activity, it was damage control. Late into the night, after markets had thinned and public attention had drifted elsewhere, emergency conversations were taking place between exchange officials and the largest bullion banks. The problem was simple and existential. The market had finally moved against them. Silver crossing $75 was not symbolic, it was mathematical. Internal risk models showed that once that level failed, the probability curve stopped bending and started pointing straight up. $80 became likely, $90 became plausible, $100 became unavoidable. And for institutions sitting on enormous short exposure, that trajectory was not survivable. They had a choice: accept the loss and face insolvency, or intervene in the structure of the market itself. What followed was not announced on television, not explained in press conferences, and not debated publicly. It was quietly posted in the early morning hours, when liquidity was thin and reaction time was minimal, a sudden and aggressive increase in margin requirements. This was not a routine adjustment, it was not gradual, it was not proportional. It was a shock maneuver designed to force liquidation. To understand why this matters, you have to understand leverage. Futures markets operate on margin. Traders post a fraction of the contract's value as collateral. That leverage works both ways. It amplifies gains, but it also magnifies losses. What happened overnight was that the amount of collateral required to hold the same position was abruptly raised. In practical terms, thousands of traders were told they now needed tens of thousands of additional dollars in cash immediately, not because price moved against them, but because the rules moved. Imagine buying an asset, watching it rise exactly as expected, and then being told mid-trade that the terms have changed. You're no longer allowed to hold the position unless you come up with significantly more money immediately. If you cannot, your position is closed for you at whatever price the market offers. That is not market risk, that is structural risk. The effect was instant, forced selling. Not because investors wanted to exit, but because they were compelled to. Artificial supply created out of thin air, not by sellers choosing to sell, but by the exchange changing the cost of participation mid-game. And even that was not enough. As buying pressure persisted, reports began surfacing across multiple brokerage platforms of restricted trading, buy orders rejected, new positions blocked, accounts placed into liquidation-only mode. This is a familiar pattern. It means selling is allowed, buying is not. When one side of the market is disabled, price discovery is impossible. This is how prices are pushed down without real sellers. At the same time, the order book began to display enormous sell walls. Millions of ounces offered at fixed levels, appearing suddenly and vanishing just as quickly. These orders were never meant to execute. They existed to intimidate, to signal false supply, to slow momentum. The volume told the real story: thin trading, no follow-through, just pressure. This is not how organic markets behave. What makes this moment different is the context. In previous cycles, these tactics worked because demand was primarily speculative. When pressure was applied, buyers retreated. This time, demand is industrial, contractual, and non-negotiable. Factories do not respond to margin hikes. Assembly lines do not care about futures rules. They care about metal in hand. That is the core contradiction breaking the system. While the paper market was being forced lower, the physical market was doing the opposite. Spot prices dipped, but real transaction prices rose. As silver pulled back from 76 to 73 on screens, physical premiums exploded. Bars that should have been available near spot were suddenly 40 to 50% above it if they were available at all. This is not a coincidence. It is evidence. In a functioning market, falling prices ease supply. In a failing market, falling prices accelerate hoarding. That is exactly what is happening now. Industrial buyers are using suppressed paper prices as an opportunity to secure remaining supply before the disconnect becomes permanent. Registered inventory numbers confirm the stress. Millions of ounces removed in days, not shuffled, not reclassified, gone. At the current pace, deliverable inventory approaches exhaustion within weeks. That is not alarmism, it is arithmetic. And here is the key detail that cannot be overstated. Once silver leaves exchange vaults into industrial hands, it does not return. It is not stored for resale. It is consumed, embedded, removed from circulation forever. This is why the system is panicking. The exchange is supposed to act as a neutral intermediary. Instead, it has become a defensive mechanism for those caught on the wrong side of the trade. Rule changes are being used as pressure valves, not to stabilize markets, but to protect balance sheets. This behavior is not unprecedented. In 1980, when silver prices surged and threatened the financial system, the rules were changed. Buying was restricted, liquidation was enforced, prices collapsed. That episode is often cited as proof that markets always win. What is rarely mentioned is that the demand profile was entirely different. That was speculation. This is consumption. You cannot tell a semiconductor plant to liquidate. You cannot tell a solar manufacturer to stop building. You cannot tell a supply chain to pause physics. This is why the paper suppression feels increasingly disconnected from reality. The most revealing signal is the spread, the gap between what silver is priced at and what it can actually be acquired for. That gap is widening daily. It is the clearest indication that the exchange price is losing authority. When the official price says 73 and the real price is 80 plus, the market has already split. One price for screens, another for survival. At this point, credibility becomes the issue. If contracts cannot be trusted to settle at prices reflecting reality, confidence erodes. And confidence is the only thing that allows leveraged paper markets to exist. Buried within exchange agreements are clauses that allow for extraordinary measures during emergencies. Cash settlement, contract modification, force majeure. These provisions exist for rare, extreme circumstances. The concern now is not that they exist, but that the conditions for invoking them are approaching. If metal is unavailable, settlement becomes discretionary. And discretionary settlement is not settlement at all. It is conversion. A physical claim turned into a cash payment at a price determined by the same structure that failed to deliver. That is the ultimate risk. Mainstream financial media has been largely silent. Margin hikes framed as technical adjustments. Volatility dismissed as speculation. Physical shortages ignored. This silence is not neutral. It shapes perception. It delays response. At the same time, industrial behavior tells a different story. Reports are emerging of manufacturers bypassing exchanges entirely, negotiating directly with miners and refiners, locking in supply outside traditional channels. If that trend accelerates, the exchange loses its most important participants. Price discovery migrates elsewhere. An exchange without physical users is not a market. It is a simulation. The attempt to suppress price through rule changes does not solve the underlying problem. It intensifies it. Every artificial drop invites stronger physical demand. Every forced liquidation transfers metal from weak hands to strong ones. Every intervention confirms that the pressure is real. This is why the situation feels unstable, because it is. Markets can tolerate losses. They can tolerate volatility. What they cannot tolerate is loss of trust. And trust erodes when rules change only when certain players are threatened. This is not about winning a trade. It is about witnessing a system under strain. The supply is tight. The demand is real. The leverage is extreme. The rules are moving. That combination never resolves quietly. And in next part, Doc, we will examine what happens when these pressures converge, when paper defenses fail, when physical pricing asserts itself, and when the gap between the two can no longer be managed. At this stage, the system is no longer trying to balance supply and demand. It is trying to manage consequences. The margin hikes, the trading restrictions, the sudden rule changes, these are not preventative measures. They are reactive. They are the actions of a structure that has already lost control and is now attempting to slow the rate of failure. The most dangerous assumption traders can make right now is that the exchange will honor contracts under all conditions. History says otherwise. Buried deep inside exchange rulebooks is a clause most participants never read until it is too late. Force majeure. It allows contracts to be altered or voided in the event of extraordinary circumstances. Shortages qualify. Delivery failures qualify. Systemic stress qualifies. If physical silver becomes unavailable in sufficient quantity, the exchange is not obligated to deliver what it does not have. Instead, it can declare an emergency and settle contracts in cash at a price of its choosing based on its own reference mechanisms. This is not speculation. It is written policy. That is the endgame risk. A cash settlement in a physical shortage is not compensation. It is confiscation by conversion. You are paid yesterday's manipulated price for tomorrow's unobtainable asset. Your upside is capped. Your hedge evaporates. And the institution walks away solvent. This is why the spread between physical and paper matters more than the price itself. Every dollar that gap widens increases the probability that delivery stress becomes legally unmanageable. Once that threshold is crossed, the exchange's priority shifts from price discovery to liability containment. This is also why industrial players are exiting quietly. Manufacturers use futures markets to hedge costs, not to speculate. They rely on stable, credible pricing to plan production years in advance. When exchanges begin changing rules midstream, credibility collapses. Hedging becomes unreliable. Risk models fail. Planning becomes impossible. We are already seeing signs of the response. Industrial buyers bypassing exchanges, long-term supply agreements negotiated directly with miners, refiners allocating production outside traditional channels. This is capital voting with its feet. When physical users abandon the exchange becomes circular. Paper trades paper. Leverage compounds leverage. Price detaches from reality entirely. At that point, the official price is no longer a signal. It is a narrative. This is where geography matters. Outside the Western financial system, price suppression is interpreted differently. When prices are forced lower despite tightening supply, it is seen as opportunity. Strategic accumulation accelerates. Vaults drain faster. What is presented domestically as cooling speculation is perceived globally as distress. This dynamic turns suppression into self-sabotage. Every artificial dip exports physical metal. Every delay hands advantage to those who settle in bullion, not dollars. Over time, this weakens pricing power permanently. Meanwhile, the structural deficit remains. Mine supply is flat to declining. Ore grades continue to fall. New discoveries are scarce. Development timelines stretch into decades. Consumption, however, keeps rising. Electrification, defense systems, solar infrastructure, medical technology, all draw from the same finite pool. Paper contracts can be created instantly. Silver cannot. This asymmetry is the core instability. Leverage grows faster than supply. Claims multiply while collateral shrinks. Eventually, one side must give. The exchange is betting that volatility and fear will force enough selling to restore balance. But forced selling does not create metal, it only redistributes claims. And when those claims are concentrated in stronger hands, the system becomes even more fragile. That is the paradox. Every intervention strengthens the long-term imbalance. The psychological dimension is equally important. Rule changes destroy trust. When participants believe outcomes are predetermined, behavior changes. They stop hedging. They stop participating. They withdraw. Liquidity thins. Volatility increases. The system becomes brittle. Markets do not fail because prices rise. They fail because confidence collapses. And confidence is already cracking. The reaction to the recent changes has not been capitulation. It has been defiance. Investors are not flooding back into paper. They are moving outward. Physical ownership, direct possession, removal of collateral from the system. This is not rebellion. It is rational risk management. Every ounce removed reduces the pool available for settlement. Every withdrawal tightens constraints. Every constraint increases the probability that the next stress event cannot be managed quietly. That is why the actions of the exchange matter less than the response of participants. The rules can change. Physics cannot. At some point, a factory will face a choice: shut down or pay any price. When that happens, the reference price becomes irrelevant. Transactions occur at whatever level clears supply. Those prices become benchmarks. Everything else adjusts to them. That adjustment is never smooth. When the paper market finally loses authority, the repricing is violent. Not because demand spikes, but because supply disappears. Offers vanish. Markets gap. Price jumps not by increments, but by regimes. This is not theoretical. It has happened before in energy markets, in base metals, and currencies under stress. The pattern is consistent. Suppression delays the move, it does not prevent it, and when release occurs, it overshoots. The irony is that the tools used to defend the system are accelerating its transformation. Margin hikes push participants out. Restrictions undermine legitimacy. Spoofing erodes transparency. Each measure buys time at the cost of trust. Trust, once lost, is not easily restored. So how does this resolve? Not with justice, not with accountability, but with repricing. Paper prices will chase physical reality, not the other way around. The gap will close, either through price rising, availability collapsing, or settlement rules changing. None of those outcomes favor leveraged participants. The exchange may survive institutionally. The price discovery function may not. And when that happens, the narrative will change overnight. What was dismissed as speculation will be reframed as foresight. What was suppressed will be justified retroactively. That is always how it ends. Until then, the signs remain clear. Rules are changing. Supply is tightening. Physical premiums are rising. Confidence is eroding. These are not signals of strength. They are signals of stress. The system is not breaking because people are buying silver. It is breaking because too many promises were written against too little metal. That imbalance cannot be negotiated away. It can only be resolved. And resolution is coming, whether the rules allow it or not. If this breakdown helps you understand what's happening beyond the charts, like the video so others can see it before the rules change again, subscribe for calm, data-driven market intelligence, not headlines or hype. Share this with anyone who still believes the paper price tells the whole story. And stay close. The next update focuses on what happens after delivery fails.